All right. Well, hello, everyone, and welcome to today's presentation, Overcoming the Objection, Impaired Risk Disability Insurance is Too Expensive. I'm your host, Seth Groff, and I'm joined today by DI expert Amy Falconer. Amy, welcome.
Thanks, Seth. Hi, everyone.
What is new in Denver, Colorado?
Well, we finally have some cold weather creeping in. The season has felt like fall for us, but I think we're going to get some colder weather this weekend. So kind of
Well,
excited for it.
you know what I like to do when the weather's cold outside?
Yeah, stay
That's
inside.
stay inside and talk about impaired risk disability insurance.
Exactly.
Appreciate everyone jumping on the call today. If you've been in sales, any type of sales, for more than a day, you've ultimately probably heard the objection, it's too expensive. And anytime you hear any objection, I think that sometimes it's good to take a step back, look at what you're currently doing, evaluate your current sales process, and see what you can do to overcome that objection, or even better yet, prevent it from even coming up. And when you look at impaired risk disability insurance, this is probably the most common objection I get. Interestingly enough, I don't hear it from agents as much as maybe I hear it from the BGA or the wholesaler. And so there is a perception about impaired risk disability insurance being too expensive. And today, my goal is to share 6 tips that will help you overcome this objection and prevent it from coming up in the first place. And so, if you're not familiar with risk and what we do, I'm going to lay out the sale for you. So, typically, an agent will meet with a client, talk about the importance of disability insurance. The client will say, yeah, I need that. They go through the application process, and guess what happens? A health condition comes up, and that original carrier declines them. That agent reaches out to see what other options are, risks, gives an offer, and says, yes, we can insure them with our impaired risk disability product. And then the agent goes and presents this to the client. And maybe that client comes back and says, you know what? I really didn't want this in the first place. I think it's too expensive. And the sale stops. And I always think that's very interesting because if you break it down, the client says, hey, I want this. They need it more than the average person, right? Because they were declined with the original carrier, unfortunately, due to their health condition. So I think that it should be a slam dunk sale. But you all know that some agents just aren't real good about presenting disability and educating their clients on it. And now you throw in, being declined once and coming back with an offer that might be more expensive than what was originally shown. It does have its challenges. So we'll kind of address those challenges, give you some tips, and if you get something out of today, hopefully you have more confidence in overcoming any objection when you meet with the client. So the first tip that I have is evaluate how you got here. If you are receiving the same objection every meeting that you have, you really need to take a step back and look at your sales process. What I always recommend doing is taking a look at, 5 successes and write down what went well in those 5 successes, and then look at 5 meetings that maybe did not go the way you went, and you received the objection that it was too expensive or whatever objection that you might have had, and look at, is there a difference in the process? Is there a difference in what you communicated to them? Is there a difference in the cadence in which you presented it? Is there a difference in the client profile? The more information you have about the specific situations of where you're receiving the objections, the better you're going to be able to prepare for them in the future. But at the end of the day, if somebody says it's too expensive, what that means is they do not see the value in what you are offering, right? And, every day we make, I don't know, 10 to 20 to 50 buying decisions, and we go through that process in our mind, right? So it's like if I stop at the gas station and fill up my truck with gas, personally, I don't go inside and buy a drink because I don't see the value in paying $3 or $4 for, a Coke or a bottle of water, right? And so I don't see the value in that. My wife does it all the time. It drives me nuts. But people see value differently. And so if you're receiving this objection, what it boils down to is you need to look at, how you are presenting the product and educating them on the value and showing them what's in it for them. Also, when this comes up, ultimately where the mistake was that you did not establish the need for disability insurance in the first place. And the one tip that I have, or one of the best tips that I have for impaired risk DI, is that every time you meet with that client, you need to reestablish the need for disability. A lot of times that happens in the original meeting, and you go through the whole process of where they were declined. Now you have a quote. Now you meet with them again. Now you take another app. Every interaction, you need to reestablish the need for disability. And a lot of agents don't do that. And that's where the disconnect is, because that client forgets that original meeting. Again, they're frustrated that they were told no. And so you need to reestablish that need every time you meet with them. And then when you're going through the value, remember to always turn it back on what's in it for them. And we'll give you some tips on how to do that with Flex DI. But ultimately, when you talk about establishing the need for disability insurance, remember that the client's ability to earn an income, and this is whether they're healthy or they have a pre existing health condition, their ability to earn an income is their most valuable asset. And so when you go down the list of all their assets, their car, their house, their 401k, the reason they have those things or all their stuff is because they have the ability to get up and earn an income. And a lot of people don't look at their income as a whole. They look at it as, their check that they get every 2 weeks or whatever cadence it might be. And in this example, we have an individual who is 37. And if you assume a 3% raise every year, by the time they're 65, over $10 million will have passed through that client's bank account. Well, not 10 million because taxes and things come out of it, but for illustrations, they will have earned $10 million. And I guarantee you, if you put that check for $10 million in front of them, they are going to look at it differently than their biweekly paycheck. And so then the question becomes, does it make sense if I'm insuring my house, if I'm insuring my car, if I'm insuring my phone, all these things that are relatively easy to replace, maybe not easy, but are replaceable. If I'm insuring all of those, does it make sense to insure the big amount or my ability to earn the income? And the answer to that is yes. And a lot of times we can do that on 1 to 3% of the income. And Amy's going to talk about this on a later slide, that still holds true on the impaired risk disability sale. And and to put that into perspective, with that $10 million, I was thinking the other day that old sales strategy, job A, job B, which one would you take? But break it down like this. If I said, hey, would you, and Amy, I'm going to have you answer this question for you. But if I said, hey, Amy, option one is $10 million, but there's a 25% chance that you lose it at some point in time due to a disability, right? Because the statistic is 1 in 4, individuals 25 will experience a disability by the time they're 65. So you get 10 million with a 25% chance of losing it at some point in time. Or I say $9,750,000 and it eliminates that chance. Which one are you taking, Amy? Are you taking the 10 million with the chance of losing it, or the 9.75 without the chance of losing it?
Obviously, the 9.75.
Yeah, and I think most people would, and you can argue with my math on there and say, well, yeah, that's not, a true representation of the percentage, but say it was 9 million or 10 million. Most people are going to take the 9 million,
9
right?
million.
So
Yep.
whatever you say is the cost of the disability insurance in that scenario. So if it protect 9 million, it's 10%, right? But when you lay it out like that, people look at it differently. And I think one of the biggest mistakes that we make in the DI industry is we look at things on a monthly basis, a monthly income. And we shouldn't. We got to look at our income as a whole, because that larger number is more impactful with the client. But remember, establish the need, and the need is a client's ability to earn an income is their most valuable asset, and everything that they have, all the stuff they have in their life, is probably a result of earning an income. So does it make sense to protect that ability with disability insurance? That's if they're healthy. That's if they have an impaired risk. But if you end up going into the impaired risk cell, you need to reestablish this every time you meet with the client and reinforce it, because that's going to help show the value. Now, when you talk about Flex DI or our impaired risk disability product specifically, these are really what I consider kind of the top five aspects of it. So, Amy, share with us, kind of some of the highlights of this product and the value these provide to the client so that you can reinforce what's in it for them when you're talking about an impaired risk disability product.
Okay. Well, obviously, we'll start with that first bullet point. We may be able to cover certain health conditions, right? And let's start with the reality that many advisors face in the impaired risk space. Traditional DI carriers routinely decline applicants with conditions such as cancer, diabetes, arthritis, cardiovascular issues, autoimmune disorders, and I can go on and on and on about the medical conditions that these clients get declined for. But Flex DI changes that dynamic. We don't automatically decline these individuals. Flex DI was specifically built to consider these clients with these conditions. So instead of saying no, we look at the big picture, right? And we often find ways to offer meaningful coverage to these clients. And these clients, they know how severely these conditions could impact their working years. So they do value the fact that they can get coverage and they value income protection. They do need it most. So it's very important for us to look at them as potential clients that you could make the sale with. And
Go,
so, go
go
ahead.
ahead. Nope. Go
Okay.
ahead.
And then on top of that, I was going to say, not only do we accept clients with these conditions, very often we don't even exclude these conditions from the policy. For example, someone with type 1 or type 2 diabetes, as long as they were diagnosed at least 6 months ago, the condition is well controlled and is compliant with treatment, we won't exclude diabetes from the policy. And some other examples, great example is non-invasive cancers such as breast cancer or Hodgkin's lymphoma. If a client has been cancer-free, treatment-free for at least 2 years with no reoccurrence, we do not exclude cancer from the policy. Other conditions I can mention is sleep apnea, certain cardiovascular issues, and I can go on and on. So the goal here is to provide real usable protection, not a policy full of carve-outs. Did you want to add to that, Seth? Are you good?
Well, I mean, I think this is probably something that a lot of people really overlook if you
Mhm.
lay it out for what's in it for the client. You have a client over here that says, "Hey, I'm not even going to insure you at all." And
Mhm.
with Flex DI for these, mild cases of diabetes, I don't like the word mild, but
But
these common cases of diabetes, cancer, heart condition. Not only are you getting disability coverage, but you are covering the condition that is going to be their primary concern. I don't
exactly.
know. I like it. I feel
Mhm.
like if you get that offer on the table, you need to take it because it might not be there next year. It might not be there in 5 years. And that's a huge advantage. In my opinion, it's one of the best advantages. If we can get that issued and cover the health condition, I'd be taking that policy. But go on.
Exactly. And the value there is, it's not the price point, it's the value that the condition is covered. So great
Yeah.
value. And then secondly, we want to add that it is guaranteed renewability to age 67. So as long as premiums are paid, the policy stays in force until age 67. There's no surprises, there's no re-underwriting, no new medical questions. And premiums can only change on a class-wide basis, never individually. So it provides long-term stability, especially important for those clients with impaired risks, right? So many of them can see their expenses increase over time because they are more at risk for comorbidities to form due to pre-existing conditions. So more hospital visits, again, medical bills stack up and they have a higher likelihood to go out on claim than your healthier clients. So having a policy that stays in force with benefits that don't shrink and the terms don't change gives them great long-term stability. And then we want to add that we have own occupation coverage for the full benefit period. So one of the strengths of FlexDI is that we can offer up to 10 years on the benefit period. And that's a big deal when it comes to the impaired risk space, because if clients do get offers from traditional DI carriers, but they have adverse history, very often their benefit period is shortened. So they restrict the benefit period, right? But with FlexDI, very often we can offer up to 10 years on the benefit period, especially for those who fall in the 3A, 4A, and 5A occupation classes. But what really elevates the product is the fact that we can add the own occupation definition for the entire benefit period by adding that own occupation extension rider. And we all in this industry know how important own occupation is on a disability policy, because that means that if the client is considered disabled, if they cannot perform their duties in their specific occupation, even if they're capable of working in another job, they will get their benefit. And then we also cover mental nervous conditions. Now, that may not be a jaw-dropping highlight because many, if not all, DI carriers do offer mental nervous coverage. And we do the same. And how that works on the Flex DI product is if the client becomes totally disabled due to mental disorders or substance-related disorders, the policy will pay 50% of the total monthly benefit up to 13 months and up to 13 months for the life of the policy. Now, while there are limitations on the duration of the benefits, the real differentiator with FlexDI isn't just how we pay the claim, it's how we underwrite mental nervous history. And that is what I want to highlight here. In the traditional DI world, if a client has condition like depression, anxiety, or stress, if that's in the medical records, the traditional DI carrier is automatically going to exclude those conditions from the policy. So it won't be covered at all. Well, Flex DI takes a different approach. We look at the client's medical history, and if they have mild depression, mild anxiety, or stress, or maybe they had issues with drug or alcohol abuse in the past. Maybe they went to rehab. If now, further along the line, many years later, they don't have issues with those conditions, for example, they haven't had an issue with alcohol or drugs for 12 months before applying for coverage, or their stress is controlled, their depression is controlled with medication, we may not exclude that from the policy. So that's huge when it comes to mental nervous conditions. And then finally, I would like to go over the fact that our benefits reset. And when we speak about benefits resetting on an individual DI policy, we're really speaking to how the policy treats new disabilities versus reoccurring disabilities. In many traditional policies, if a client becomes disabled again from the same condition within a certain time frame, and typically that's 12 months, that reoccurrence is treated as a continuation of the original claim. And that can be helpful because it may preserve the benefits without requiring a new elimination period. But it could also work against a client because with some DI policies, the carrier will only pay up to a certain aggregate amount of benefit. So with Flex DI, we keep it simple. The benefit amount and the benefit period resets for every new disability occurs as long as the elimination period is satisfied. And this is, again, very important for anyone who has impaired risk, right? Because these individuals are more likely to experience multiple health events over their working lifetime. So knowing that their benefits resets gives them long-term protection and real financial security.
Yeah. So, just to kind of recap, when you're kind of educating the client on what's in it for them, remember the three C's. All right. So the three C's, we may be able to cover your condition. We're going to be able to cover your craft with that own OC definition all the way out to a 10-year BP, which is the longest in the impaired DI space. And we're going to cover crazy with that mental nervous. And the good news is you only have to be
Mm.
underwritten once on this policy. And once the offer's on the table, it sticks as long as you pay the premium. So Well done, Amy, and thanks for going through those top features of Flex DI. And remember the three C's when talking to them. All right, tip number two, own the high price up front. I always tell a story about my stepdaughter, and we're sitting around at Thanksgiving, and she's getting off of her dad's auto insurance and had to go out and shop her own. And she had a couple of wrecks that, of course, weren't her fault, but in the eyes of the insurance company, they were. So going through there and getting these quotes, and she's going through online quoting process for auto insurance, and gets to the point where it's the quote, and I don't remember what it was, but I just remember all the grown-ups in the room kind of groaned like, oh man, that's a lot for insurance on a car that's not really a lot of value. And so but interestingly enough, like when it comes to auto insurance, if you have a lot of wrecks or you've got a lot of speeding tickets, your premium is going to be higher, and like no one will even second guess that that's the case. We're all programmed for that. Yet when it comes to disability insurance, and now we're able to cover someone with a product very similar to what was originally sold, and now it's more expensive, and they're like, what, it's more expensive? Why is it more expensive? Because we are covering a risk that other carriers won't. And so a lot of times it's going to be more expensive, but if you look at what was originally sold to them, like a doctor, for example, probably was sold non-can, age 67, ONOC definition, some other bells and whistles. They were probably sold a high, a relatively high premium DI plan. It's not that much more than what was originally sold. But what happens in the industry is that really they have two options in the impaired risk market. They can go with a graded product like Risk Flex DI, right? Or they can go with the Lloyd's option. And for some reason, when it comes to the impaired risk sale, the agent gets both of them, kind of sends them to the client, but doesn't, explain the differences. And you can go all the way down to the bottom and look at the difference in the premium. The Flex DI is $375, where the Lloyd's option, which we do Lloyd's as well through IDU. So I'm not saying there's anything wrong with it, but I have strong opinions about getting the right product for the right scenario. And in impaired risk, I have a strong belief that Risk Flex DI is usually the best solution. So you can see that it's more expensive, but look at the reasons why. And the biggest reason why is because Flex DI is guaranteed renewable to age 67, where a Lloyd's policy is renewed every 5 years. And what happens at those 5 year renewals? It is underwritten again at the time, so they can flat out decline it. Right? The Lloyd's cover holder can say, "Sorry, your condition has got worse. We don't want it." Also, at that renewal, they can add additional exclusions. So now you've had some other health condition pop up that they don't like. Now that can be added to the policy. And the third, the price is going to increase. And you don't know, like this client was a 40-year-old. I cannot tell you what the cost of their Lloyd's policy is going to be at 60. It's just going to be more. And if you use current rates and assume that, nothing else changes, they actually end up paying more for the life of the policy through Lloyd's with the projected price increases than they would with the level premium of Flex DI. So the fact that it's only underwritten once, yes, it is going to be more expensive. It's not like this is some secret policy. The Lloyd's knows that having the ability to reevaluate that policy every 5 years gets them off the hook if things start going south for that client, because they don't have to reissue it. So that's that's worth it in my opinion, as well. The process, we issue these Flex DIs without medical exams, so we're underwriting with the application, order an APS. Depending on the cover holder, they might have to go through exams, things of that nature. Mental nervous disorder, obviously the domestic carriers have a mental nervous clause, but most Lloyd's options are going to exclude alcohol and mental nervous. So if you want to cover crazy, you might want to go with Flex DI. And I always use the not Breaking Bad, Better Call Saul. If you've ever seen that, where the brother is the high end lawyer and he kind of just loses it, like it happens, right? Like you don't expect it to, but that individual wasn't working because of his mental nervous condition. And so, a DI policy would have at least paid some in that scenario. Level premiums, right? Versus increasing every 5 years. How much? I don't know. We're, buy a policy and say, hey, we'll tell you in 5 years how much it's going up. We'll talk about it then, right? Not a great deal. Benefit resets with the Flex DI, which is great. And, just the underwriting disclosure or exclusions. Most Lloyds are going to have a lot of exclusions, some warranties, and it's very specific of what they're not going to cover. So if you can get the Flex DI issued and cover that condition, I think it's worth the overall premium. So yeah, it is going to be more expensive because it's a better policy, and the chances of collecting a claim on a Flex DI is a lot higher than on a Lloyd's product, because every 5 years you can adjust that policy on a Lloyd's to get out of having to pay. So yeah, when people say, well, Flex DI is kind of expensive. Yeah, no kidding, because it's a better product than going with the Lloyd's. Tip number 3, you automatically DQ 20% of your prospects. This is just the reality of any sale. So, basically you have 20% that's going to buy the best thing. Like if you look at some doctors, right? You say, hey, look, I know we talked about, XYZ company for disability insurance. Unfortunately, they said no. This Flex DI is, the best product in the impaired risk. There's some other options, but they're just not as good. They're just going to say, yeah, great, sign me up. That's 20%. 60% have to see the value. So you kind of have to go through the value, that list of how it compares to the other options. So 60% can be swayed either way. And then 20% just aren't going to buy it, right? Like I am not going to walk into a gas station and buy a Coke unless I'm really, really thirsty and I don't have any other options, because I'll just wait till I get home and get it out of the water filter out at home, right? So that's the same with anything that's being sold. Is if they don't see they're just not going to be a good client. So don't spend a lot of time with them. Focus on the ones that are automatically going to buy and the ones that see the value. And a lot of times this is lost because, impaired risk is always a subset of the total disability that you're selling. So you might only have, a handful of these presentations a year, and, you get 2, 3 in a row that says, no, I won't buy. That's just, you might got a streak of ones that just wouldn't buy anyway. So I always just tell people with objections, know that some people just aren't going to buy no matter what you do, and that's okay. Don't spend a lot of time with it. Get to the ones that you can persuade. Tip number 4, when you receive an objection, specifically impaired risk disability is too expensive, slow it down. In the sales training that I've had, anytime there's an objection, the first thing I do is I count to 4 in my head. So, and I'm using that time to gather my thoughts, because the mistake that most salespeople do when they get an objection is they go back to whatever training they have and they say, you know what? I have talking points for that. Well, let me go on a 5-minute tirade about why you are wrong. And that's what most people do. They start going into, listing all the things. Well, Flex DI is guaranteed renewable and da 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 da, which is all important, but that's not the time to go through it. When you receive the objection, pause. And then the next thing that should be out of your mouth is a question. What prompted you to say that? Can you expand on why you believe it's too expensive? Because the reality is if you have 10 people say it's too expensive, from a high level, it means you didn't, establish the value in relation to the price. But the reason below that, you're going to have 10 different reasons if you talk to 10 different people. And if you don't know their specific reason, you're not going to be able to overcome the objection. So I don't know. They might think it's too expensive because they just had to, write a check for $20,000 for their child's college tuition. Maybe they just had a serious medical condition where they had out-of-pocket expenses and they're, overburdened with health bills that, now they can't afford a DI premium. I don't know why they think it's too expensive, but if you don't know the answer to that, then you're not going to be able to overcome it. And the only way that you can find it out is to ask more questions about it. So ask a question, then dig to find out the real reason why, and then that will help you with the two options. So after you dig, you find out the true reasons why they think it's too expensive. You come back and you say, "Can I throw some ideas at you?" Because if it's too expensive, it's too expensive. Sometimes they might come back and say, after they walk through that, you ask them questions, they say, well, maybe it actually isn't too much. Sometimes they'll actually talk themselves into it. But if it really is an issue as far as fitting into their budget, there's two options. One, they can change the option or change the offer, or two, you can help them find the money. So Amy, why don't you walk through, what their options are if you want to
Mm-hmm.
change the offer?
Again, to your point is we need to change the narrative instead of, walking away from cases where, the agent and the client thinks more often it's the agent that thinks it and they don't even show the quote to the client, right? So
Yeah.
change the narrative. Instead of walking away, we can change the offer, right? We reshape the plan so it fits the client's budget while still giving them meaningful protection. So strategy one that you could use is to build what we call a minimum contingency plan. And I stole that from someone, I won't tell you who. And what that means is take a step back and look at the client's essential expenses, the things that they absolutely have to cover if they don't have the ability to work and earn an income. So think of, the concept of mug coverage. And I think all of us have heard that term before. So mortgage, utilities, and groceries. If we design the benefit amount around those essentials, we can often bring the premium down to a level that is comfortable for the client. Strategy two is looking at the elimination period, maybe extending that elimination period. So look at your client's budget, look at their savings, right? Maybe they have an emergency fund that could carry them for 6 months or a year. So instead of choosing a 90-day elimination period, they might opt for 180 days or 365 days. And that adjustment alone can significantly reduce the premium. And then, of course, we can look at shortening the benefit period. Instead of taking that 10-year benefit period, they can take a 7-year or a 5-year or a 3-year benefit period. It's about finding the right balance between cost and coverage. But really, the value about FlexDI is that it opens the door to clients that would otherwise be declined in any other space when it comes to individual DI. And that's the greatest value. So you have to reframe the conversation, put things into perspective for the client. Don't be afraid to do the uncomfortable thing. Often in life, when we do the uncomfortable things, we get the greatest reward, right? So one thing we like to say in the individual DI space is that we only need 1 to 3% of our income to secure adequate disability coverage. That's 1 to 3%. So instead of talking about the premium itself, tell the client if we can take 1 to 3% of your income, we can give you adequate coverage to cover your mortgage, utilities, and groceries.
Yeah, and Amy, you said something that really stood out to me, and I think is a mistake that we see a lot in the DI world is that the agent is making the decision for the client
Hmm.
and isn't
Yep.
even, walking it through it, right? They think
Yeah.
it's too expensive. They're not the one with the health issue and the risk
Hmm.
looming over their head, right? And
Exactly.
so don't make that decision for the
For the
client,
client.
but so I think that's very something that, you got to actually kind of call out some agents and said, do you think it's too expensive or do your clients? But
Mm,
to kind of piggyback on what you said, as far as 1 to 3% and like the cost of this product, this particular client that I ran here these quotes for, first of all, we have this nice attachment in the quote that shows different benefit periods and also different elimination periods. And this one you can see we did 10,000 a month. That's $120,000 a year, which is 60% of 200,000, right? So this client makes 200,000. So if you apply the 1 to 3% rule or up to 3% of income, that's basically $6,000. And so the 90-day tenure is still less than 3% of their gross income. And I mean, we can modify this, down to, 3,000 would be, what would that be? 1.5%. So there's just a lot of options and flexibility here. And, going with that 180-day plan, which I think that for high income individuals is often overlooked, right? Because you look at, like, how much vacation does the client have, right? Like, do they have 3 weeks banked? Okay, well, 3 weeks, that gets them 3 weeks of pay, right? Then they're probably paid, in a 2 month lag cycle. And then you look at what they actually do have in savings, right? Like, my wife and I, we have 6 months of savings, readily available if something happens, from a planning perspective. And so a lot of people are financially secure, and so they might, especially, as their income increases. So 180 days might not be that hard for some people, where lower incomes, you might have to go to 90s. But I just like looking at this graph, because usually you can see and find a plan that, it's going to fit their budget. And then, just to go back to what Amy said about mug, like, drop this client down to $8,000 a month, and you can see now, we're able to drop that premium quite a bit. And so there's a lot of flexibility there. I always recommend, starting with the 60% of income, but there's a lot of levers you can pull there. If they say they, see the value of disability, and you have an idea of how much they might be able to allocate to it, a lot of times you can, change the policy to fit into their budget. Now, the other option to changing the offer is to help them find the money. And this is another example where, I think agents do a poor job with, is they stay away from the B word, right? The B word is a cuss word. No one wants to talk about it. And I'm not, thinking what, you're probably thinking. I'm not going to swear on this webinar. The B word is budget, right? And do you talk to your client about their budget, and are you willing to help them look at their budget and not tell them what to do, but show them areas where they might be, spending money that is going to be better suited? And none of this is like attacking really their, I don't know what I guess, lifestyle budget, right? If you go to someone that is used to getting Starbucks every day and you say, well, just don't go get that Starbucks every day, they're going to go get that Starbucks every day, right? You're not going to change that habit. But if you look at everything they do and they don't want it, right? They might think that value of that Starbucks is more than the value of disability insurance. And who are you to judge of what their priority is? They don't see the value, in, dropping the Starbucks. But a lot of times you can look at their budget and find other areas to save the money. Review the insurance portfolio and, identify low priority versus high priority. In my opinion, if you are young, working, and rely on your income, you better have some term life insurance and you better have some disability insurance. And I'm not saying other products are bad. In my opinion, those two are going to be my first two that I think are the high priorities, because those are going to be big, your big events that will drastically impact your family's financial future, right? And so if I don't have those, I'm looking at other insurance that maybe I bought that I don't need. For example, if you work at a company, you've probably been presented like worksite benefits. And I'm not saying there's anything wrong with them. I've actually sold them in the past. But, instead of buying that accident plan for $20 a month, maybe we should put that $20 towards disability insurance first, right? Or, that $120 a month, or not month, but, I got this vision plan, it's $120, but I don't go get new glasses, so it's not really worth it. Like, look at, insurance that maybe are covering low exposures, dropping it and putting it towards, the high exposure is something to consider. I do it with my wife. My wife, is a nurse, and she'll be like, oh, I bought this through the open enrollment. I'm like, Stephanie, we don't need that. Let's cancel it. Do you realize what I do? And but there's other people there. So I look at everything that I'm paying for as far as insurance and say, okay, do I need this? Is this, premium I'm spending on this product, is that really a risk I need to insure where my income definitely is? And I think that a lot of times by looking at all that, you can, help the client make decisions. Again, don't make it time for them, but help them make decision. Is it time to shop? And this is specifically for property and casualty. And I'm not a property casualty agent. And if you're not a property and casualty agent, you shouldn't be educating on it. But you can say, when was the last time you shopped your PNC? And if you have a PNC agent that you work with that you can refer them to and do a free quote, a lot of times you can save some money there as well. I spent some time. His name is Dan Johnson. He was a mentor of mine when I first got into the industry, and I went and ran some appointments with him. And that was it. In his first meeting, he always asked that question. He said, if you want to look, I have a guy. He does pretty good, and he's a lot. So many of the people were like, I haven't really looked at my PNC. I don't really even know who my guy is, and it was a referral. That PNC guy loved it because he was getting new business. He referred business back to Dan, but a lot of times, that he could free up money. And then the last one is switch to annual payments. So again, a lot of times, like for insurance and other things, if you're paying annually, you get a reduced amount. And so, if you can afford paying it annually, a lot of times you might be able to free up a couple $100s as well. So insurance portfolio reviewing it, it's pretty easy to find some areas where there might be some savings. Unused subscriptions. Again, I've done this with my wife multiple times. We're guilty of signing up for free subscriptions that start charging credit cards. Recommend going through and looking at all these at least once a year. Usually you find stuff, and when you list them all out, and then you say, okay, we're really not watching this. Let's cancel it. It's just something you have to do periodically because these subscription models, they know human nature and they know how to take advantage of it, and you just have to be diligent about what's coming out of your bank account. And if you're not using it, or if you don't see the value, or if that value is not as high as disability insurance, canceling them. And then a lot of times you can find some money there as well. And then my other stepson, Devin, oh my goodness, he causes me a lot of stress. But I kind of went through his budget with him, and I love him to death, but he doesn't make the soundest financial decisions. And he bought this camper. He was going to use it. He worked for the railroad, and he was going to travel with this camper. And then he decided he doesn't like traveling with the camper. So what did he do? So he went and he's got it stored somewhere. And I'm like, Devin, easy money right there. Just sell the thing, get what you can out of it, and then at least you're stop paying the storage, right? Same for like storage units. Just there's a lot of things that people do that it's small amounts, but if you find 5 to 10 small amounts in someone's budget, usually you can find $100 to $200 for disability insurance, right? So I think that we automatically go to reevaluating the offer, which is fine. But if you can help them find money in their budget where it's not really impacting their lifestyle, they're more likely to buy it. And I think it's something we all need to spend a little bit more time on. So with that, those are my 6 tips. Amy, any last concluding thought or tip that you want to share with the crowd today?
Yeah, I mean, as we wrap up, just a few takeaways, is that our Flex DI product, the value really is there as far as opening the door to those clients who would otherwise be declined in the traditional DI space. It gives advisors real solutions for these clients, right? Especially with those conditions that can be covered as well as not excluded from the policy. And that we mean we have own occupation protection on the policy, guaranteed renewability to age 67, mental nervous coverage. And again, with mental nervous conditions, we may not exclude those. And again, when agents and clients feel that the premium is higher, we can always reshape the offer to fit the client's budget while still protecting what matters most. So don't walk away from these quotes and these premiums. Let's have a
Yeah.
consultative conversation and change the offer.
Yep. No, well said. Amy, thanks for joining us. If you guys have any questions or have an individual that you would like to see a quote on, you can send it to quotes at usriskinsured.com. You can also reach out to Amy or myself, and we'd be happy to walk you through the quote and the sales process. So hopefully you found today's presentation beneficial. Appreciate all of you, and let's play some impaired risk DI in the near future. Thanks, everyone.
Thanks, everyone.